Thank you, Tom. Now I'm going through internal crisis of if I need to quit and found my own company since I'm in my 30s, but we'll deal with that another day. But I want to introduce our next panel. It's called How Institutions Are Adopting Digital Assets. We have as our moderator, Darren Langer, who is our managing director. Unfortunately, Andrew Chen has COVID and could not join us, but he is a portfolio manager at Lockheed. We have Clara Bullrich, who's a managing partner at Alvarium Investments, Jeffrey Barnes, who's a director at UVIMCO, and Michael Tanney, who's a managing director at Magnus Financial Group. Does everybody have questions? Okay.
Great. Hi, everyone. My name is Darren Langer. I am head of institutional IR and business development here at Arca. And it is my privilege to be here discussing institutional adoption and digital assets with the panel here that we've assembled. And to my left here is Michael Tanney from Magnus Financial Group, Jeff Barnes at UVIMCO, and virtually we've got Clara Bullrich from Alvarium Investments joining us as well. I would love to kick this off just by having each of you just give a potted summary of who you are and the organization that you work with and your kind of roles and responsibilities. And Clara, if you wouldn't mind kicking it off, that'd be great.
Yes, sure. Hello, do you hear me right?
We do.
Okay, good. So hello, everyone. My name is Clara Bullrich. I'm originally from Argentina, but I came to the US 25 years ago. I spent 20 years in the financial industry. I'm a partner at Alvarium Investment, which is a multifamily office that manages over 30 billion under management. I'm also a 10-year investor in technology through the Venture City. And I'm sorry I couldn't be in person, but I'm excited to be part of this conversation.
Hi, I'm Jeff Barnes from UVIMCO. It's the University of Virginia's endowment. We're about $15 billion to set up, I think, the nerdiest group of areas to cover. I cover digital assets, absolute return hedge funds focused on quant and macro, and then I work on operational due diligence there.
I'm Michael Tanney from Magnus Financial Group. I am the small guy in the room. Right? We have about, as of last week, earlier in the week, we had about 1.5 billion. Now we're maybe 1.25, but we're growing rapidly. But as you can hear from the sizing, we're more on the emerging side of building out the family office. But I think we all take that fiduciary type role pretty seriously, and we're probably gonna have a lot of commonality just on different sizing among all of us.
Perfect, thanks. So here at Arca, we are clearly specialized on digital assets, and I think it would be helpful to get your perspectives, at least on kind of where you see, how you define digital assets within your organization, and who in your organization is responsible, or where it fits in, and who takes ownership within your organization of digital assets. Clara?
Yes, so digital assets are anything that is stored really digitally in the blockchain. So these are electronic files that you can own, you can transfer, you can use as currency for transactions. And so all of the records of ownership are living in the blockchain, which is a decentralized database. And so we have, there's many types of digital assets. There's these liquid tokens that would be Bitcoin and ETH. Then there's the non-liquid tokens that are more kind of venture-like tokens. Then we have the NFTs, which are non-fungible tokens, and stable coins. And so as investors, we get to choose, what type of assets suits, us best and our clients in terms of risk return. And so I am the person leading the digital asset committee within the multifamily office, and that's how we do it.
Excellent.
Yeah, so I think the thing I'd add, so we put digital assets underneath our venture portfolio, which I think is common for endowments and foundations. Naturally, there's not a strategy to put it in. So it falls under that oversight. To Clara's point, the piece that I would add is infrastructure. All of those investments that support digital assets, whether it be centralized CFI entities, whether it's payment rails, whatever it might be. We categorize when we look at our digital asset risk. We include that.
I agree. We put everything in the riskiest bucket, not because we think it's necessarily the riskiest, but just from a pure volatility perspective, it would be disingenuous to put it somewhere else. It's like frontier stocks on steroids in my head. So I don't ever want to misrepresent that. I'd rather underpromise and overdeliver than the opposite. And from the sake of our organization, not so much how we allocate or invest, but how do we think through it? We have an investment committee that meets quite often. Ultimately, I'm kind of the younger guy that breaks things. That's kind of like turned into my role. And we'll talk more about clientele and what they're asking for. But essentially, it's driven off the fact that a lot of younger generations of wealth see an opportunity that other generations can't really see. I'm not 100% sure why that is that way, but sometimes I think the opportunity is so big you just can't see it. And so I've been a big driver at the firm of breaking stuff. And we do it specifically not by directly investing in coins, but going through the whole gamut and using different vehicles and teams that we trust. Because at the end of the day, there's plenty of opportunities I've missed in single names that I look back and say, holy cow, but I'll actually have no idea what I'm doing on those single names. I don't live, breathe, sleep it. That's not my role either. So it's just, anyway, it's very exciting. I'm sure we'll talk more about that.
Yep, that's a good segue. I appreciate that. So having said that, maybe Michael, you can start there and continue that thought around what stage are you at currently in terms of, do you have exposure? How are you getting that exposure and what types of vehicles? What does that look like today?
So I've taken an approach at the firm level that's similar to how I was formerly at Goldman Wealth Management for about a decade. That's like my DNA, for better or worse. I learned a lot, especially through the crisis, and taking the approach that you need to build out your portfolio over time. You can't be bulleted as in just go for it and call it a day and hope that you timed it correctly. Because there's sometimes you're going to time it amazingly well and look like a genius, and other times you're going to look like a fool. But if you stay to a disciplined approach and say, look, there's X% of the portfolio on the invested capital side, not on the market value side, that we want to deploy into these types of opportunity sets. And if we're disciplined on our tranching in, whether it feels good or bad, it's like the dollar cost average type mentality. And we do this with a disciplined approach, it's going to blend together really beautifully. And you're going to have distributions or the opportunity to roll off, and other times when they're calling capital, and over hopefully a 5 to 7 year cycle, unless you have a catastrophe, and that people understand catastrophes are outside of our control. We actually have no idea what's going to happen tomorrow, and people know that, and they appreciate our honesty about it. But if you have this beautiful stream where you have capital being deployed and distributed back, you start to create an ecosystem, and it's all about compounding at the end of the day. And if we can more efficiently compound people's portfolios, and it opens up the opportunity on a holistic level to then pull from other areas, right? Bonds, equities, or go back into them. It creates this flexible environment where you're not just taking one arrow in your quiver and saying, I'm going for the bullseye and let's see how it goes. It's actually saying, no, I got a whole quiver of arrows and I'm just going to constantly deploy them in a disciplined manner. So that's how we're seeing it. I don't know if we're in like the first, second, or third inning. And I say that, but I also don't know if we're in a 9-inning game. But I'm confident that we're very early in whatever game we're in.
Yeah, so I think for us, so we're, as an endowment, we followed the traditional endowment model. Vast majority of our assets are through external managers, very little held directly. And so you had this idea sometime in the middle of last decade where if you were in generalist venture funds, you had crypto exposure, whether you do it or not. So they did Coinbase, a couple of them did Bitcoin, Ether, whatever it might be. And then you also have the byproduct of being on a college campus. You're hearing, it became a topic of conversation, call it 2015. So our work on the space goes back to then. We have IC presentations going back to 2015. Around 2019, we took the time and said, okay, we need specialist exposure. It's a different market. How you become liquid is different. The downside risks are clearly different. And then the liquidity, like a traditional VC doesn't necessarily know hasn't had the runs up the hill on how to handle something that goes liquid in 2 years. And so at that point, we started making a few manager allocations to crypto native or crypto specialist, whatever it might be. And so I think now it's not a super exciting way to say it, but we kind of view it the way we view other strategies. We have a core mix of manager relationships. When new opportunities come from a bottoms up standpoint, we consider it, but it's not viewed as this, aggressive bet one way or another. It's just kind of part of the investment landscape for us.
Thank you, Clara.
Yeah, I would say that we have been and we're still are gold believers. And so we actually started with Bitcoin as a store of value. And at that point, very much in comparison with, gold and commodities. And so then we went down the rabbit hole and realized that there was, so many other ways to get exposure to digital assets than just, Bitcoin or Ethereum. And so the more we understood the use cases for Ethereum, the more we were able to find opportunities within the asset class. So the way we are getting exposure to digital assets is really by mapping the ecosystem. So we divided the assets in different classes. And so when it comes to cash-like assets, in other words, stable coins or Bitcoins, we're pretty much investing through institutional platforms. And then we're getting exposure to other classes, liquid token, yield generating, venture, and all of that is being done through funds. We acknowledge that the best way is through managers that have been super involved in the space, that they have a deeper understanding of infrastructure and know how to spot the right opportunities and really manage risk. So, Ultimate is really looking for the best alpha and really great educators in those fund managers.
Thank you, Clara. So today, today as it stands, I mean, how does your view kind of sit today in terms of on the liquidity spectrum, liquid versus illiquid investment opportunities? I'm curious kind of where you are today and kind of, how your view overall has changed over the past year or even over a shorter period of time.
Are you asking me?
Sorry.
Oh,
Yeah.
Okay. I'm sorry. So yes, so as I said, we really started exploring Bitcoin as a store of value, but we decided that there was more to it, and so it wasn't just talking to managers, and that's why we created within the multifamily office this committee called Digital Assets. So we were having weekly conversations around markets. We were analyzing fund managers. We were deep diving in trends in terms of infrastructure, the different layer ones and layer twos, and all of those apps that were being created in those chains. And so, and probably also in terms of different themes too. We were very much interested in understanding more in depth DeFi, things like DAOs and gaming. Those were things that we were really very interested on. And so it was an interesting moment, and it still is in many reasons, because we couldn't rely on banks like other assets to find better understanding of digital assets. So we really had to develop that kind of expertise in-house. And so it was mainly by putting a lot of time and into the space that we actually saw this change in terms of understanding the asset class and feeling comfortable with that asset class.
Great. Michael, how has your view as an organization changed over the past year and more recently?
It hasn't changed in regards to the excitement and the future potential, but it has reminded, I'd say not reminded us, but it always is helpful to be reminded that things don't always just go straight up. It's not always a Goldilocks period, even though you wish it potentially was. But it reminded us, and it took me back to 08, 09, where again, I'm like scarred a little bit, even though I'm a younger guy, I'm still scarred by it, because I saw really sophisticated, really smart, really wealthy people, really powerful people who were in massive liquidity traps. just massive. And not only could they not come up with the liquidity they needed just to pay taxes, let's say phantom taxes or whatever you want to call it, but they also couldn't do anything to take advantage of an opportunity. They were literally stuck and they were trapped. So I'm really ingrained in that, and I've learned that the mantra's always been, you always want to have liquidity. So you got to be careful on how you allocate, because if you over allocate, you never have the liquidity to then take advantage. And of course, there's obviously a self-fulfilling prophecy. At some point, you have no liquidity because you keep putting it in, but at least you have a plan to deploy versus just, again, shooting once. So with regards to how we're deploying or how we see, we've made it a point where we use funds that are liquid assets, right? I'm not saying we trade them every day, but the teams trade, and the gas pedal's basically always on, and they have full discretion to do as they please, right? Whatever they see at that moment, they could be cash, not whatever. That's why we're paying them to be the manager. But at the same time, we also have the private venture side where they're going to call capital randomly, and we just always need to be prepared. So the point is, we have a portion of it where gas pedal's always down at all times. We're not market timing, but let the individual manager decide, push and pull, but we're fully allocated at all times there, and then deploy to the private or the alternative venture side where they're going to call capital when they see the opportunity. So it's more of building out that robust holistic system and really factoring it into a bigger picture portfolio longer term and being prepared to be able to take advantage. Hopefully not too early, right?
Yes. So I think, speaking from an E&F standpoint, the initial focus was on venture funds. So first, if you looked at hedge funds, if you're in a market where things go up 4x and then down 8%, it's really difficult with the fees. So you're going to pay a ton of fees and then be under your high water mark. And then that sounds great. You won't pay fees for a long time, but can they retain the team? And so the investment becomes unstable. And so a lot of us looked at the market, call it 2019, 2018, said you can't do hedge funds. You got to go in venture. And then that was also nice because it's a 10-year bet from us. We don't have to take mark to market, and we're happy to pay you once the cash is coming back to us. I do think that the last 6 weeks, Luna in particular, will change that, because I think as more stories come out, I think people are going to see that the venture funds that were locked up got hit really hard and there's nothing they could do. The hedge funds that were able to move around can lead to a certain outcome. And the pain of the drawdowns might be different in the future. So as there's more buy into the market, the up cycles will not be as aggressive. The down cycles potentially will not either. And so that makes hedge fund fee structures a little more favorable. And so you can definitely see E&F peers starting to look more at hedge fund structures and things like that as were before. I think, they're just as happy to put it away for 12 years and see what happens.
That's some helpful perspective from all of you guys, and maybe just keeping it with you, Jeff, in terms of sort of what the big picture long term, how do you see this kind of taking shape over, I don't even know what you define as the sort of duration here of this sort of secular opportunity in digital assets, but where do you think this goes ultimately in terms of your portfolio and allocation decisions?
Yeah, so from a personal view, I'm obviously exceedingly bullish. I think this changes a lot of things. I think composability of protocols changes the way companies are innovated. I think I was talking to Andrew, who's going to be on this panel. I spent a lot of time coding 5 years ago. And as you work with open source coding protocols, you start to realize that, hey, if I can use packages other people made, I can look like I know what I'm doing way faster than I do. And so if you think about that from company scaling, it's obvious the innovation cycle will be faster. But I think from an investment standpoint, we're long-term capital by design. And so what we're really trying to do is capture the highest percentage of talent in the country and where it's going, what it's doing. And so if you say that crypto companies are now becoming an aggressive competitor to, what was tech for a long time, what was Wall Street before that, if it becomes a real competitor, then it's a place that we need to allocate capital. And it doesn't have to be any more challenging than that. What's the best talent coming out of university and where is it going? And our allocation should not exactly follow that, but that should be a guide to what we're doing.
Michael?
I actually, I'm a very big people person. I invest in people. I obviously love ideas. We all love exciting ideas, but we all have exciting ideas, and they're not always good. But high quality people are high quality people, and I 100% agree with what you just said, which is follow the talent and follow the yeah, just follow the talent. There's such a, I'm not saying finance is dead or anything close to that, right? The world of finance is very smart, very happy, and they're going to be fine. But if you look at the brightest minds, where are they going? And I think you're seeing you're seeing a pendulum swing both from a talent perspective going towards digital assets, but I think you're also seeing big companies out there, and I don't even need to name them, they're the big ones, that are losing talent, not because it's not an exciting place to work anymore, but they're just too big. They've gotten too big. And the pendulum swings both ways. And I think that there's a clear opportunity for these people who are real rock stars to build on their successes and have more meaningful impact and more aligned with their own interests and mission statements to better the world. And I think there's nothing wrong making money while bettering the world in digital asset land, because they can really make an impact. So while our portfolios are not based on investing purely on people, the fact is you have to follow that trend. You'd be a fool not to follow it and watch it closely. And maybe that's an oversimplification, but smart people working with other smart people typically succeed.
And ultimately, what does that lead to in terms of, an allocation? Not specifically, but
yeah, I hope it leads to a problem where the allocation is so large that we have to say, what are we doing? Like that's a good thing. We're sitting on massive tax bombs, like that's like the dream come true in a way, right? I don't have an answer, but I know with confidence that the opportunity is massive, longer term, and the previous speaker mentioned short term, you become a short term investor and losses. Like it's totally true, right? It's like the roller coaster of investing. We use this analogy often, and hopefully you're hearing from my perspective. Like I'm a simple thinking guy, and I like to keep it simple. If you go on a roller coaster, there is a seatbelt and a harness for a reason. And you get to the top of the first drop, they purposely go click, 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 stop on purpose to get your mind triggered. And then the first drop is the biggest. And I think everyone who's a really good investor and a smart person knows that if you stay in your seatbelt, you're going to survive the roller coaster. It's if you get out of your seat that you're actually going to get really badly hurt, if not worse. So it's kind of like that. But I do think ultimately the pendulum will swing too far. And I hope one day that happens, where then we're having the same conversation saying, look, these digital asset firms are too big. Now you're seeing a brain drain somewhere else. And it's going to happen. I don't know when, but that's clearly in my mind, the trigger to say, okay, maybe the ride's kind of over from the pure explosiveness. Now we need to look at the next opportunity set.
Yeah.
thanks.
I-
Clara?
let me
Sorry,
jump
go
in
ahead,
real-
Jeff.
I think from an institutional standpoint, when you think about, you have to remember that the vast majority of firms have gone to some sort of quantitative way to figure out their asset allocation. Like strategic asset allocation is a thing that every institutional firm is doing. And so you look at the pieces of that, which will lead to how much people invest in digital assets. The volatility is the main question. If volatility sat down and you had a strong expected return with low volatility, we would all kind of go in aggressively. So I think that's going to be the question. The alpha that managers can generate is going to be the question. And then this isn't directly in it, but the regulatory. Like you can't, like if I said like, hey, 40% of the assets should be in digital assets, you can't do that if there's wipeout risk from natural vol or regulatory. And so a regulatory framework that allows people to feel comfortable that it's not going to get rugged by politicians in Washington is the kind of missing piece for people to size it the way I think they may want to based on their risk expectations.
Can I jump in for one thing? And sorry, I know, I think that's actually the exact reason why it's so exciting, is because the people who see that it is moving that direction and can see that it will continue to move in that direction are really excited, because while we don't want anything bad to happen in our digital asset environment, bad things happen. You have bad actors, just bad things happen. And not that you want them to happen, but they're really healthy to happen, because every failure breeds opportunity. And all these failures are only strengthening the ecosystem and bringing more credibility, which then brings in potentially more money from a place like you and from all these other places. And then me with my couple billion, which is still a lot of money in theory, but compared to some other institutions, it's not. nothing, we're just going to ride the surge, right? You just got to hang on tight and wait.
Thanks for that. Clara, long-term view here?
I actually I agree with both of them. But from the institutional standpoint, we started investing, when COVID hit. So we were lucky to get a little bit of exposure there. We fairly did some investments on the hedge fund side, on the liquid token side, and on the venture side. And we're sitting in cash. So we're currently looking for yield generating opportunities in terms of funds, and we're also looking for alternatives for the cash, right? And so we understand that in order to get a decent return nowadays, we have to take bigger risks, and so we are evaluating opportunities within stable coins. We're also looking at specific themes. So the way we think about it is, the massive adoption of digital assets is really not going to come from DeFi, even though, probably we all feel very comfortable with DeFi coming from the financial industry. But probably similar to what happened with Web2, gaming might be that gateway, to tech, right? And so this new adoption could probably come from gaming again, and probably NFTs, because it's easier to understand and to use. So we are at the moment analyzing funds in the space that do that more specific. So probably those themes, but we've done already hedge funds and we've done already venture, and we'll probably keep on doing it. But it's mainly, those are the three things that we're looking at.
Thanks. And then sort of in terms of, I guess you guys sort of gotten into this a bit already, but in terms of the biggest challenges in terms of institutional adoption and getting everyone on board and making allocations in the space, what do you describe as the biggest challenges to allocating in the space? Clara? Well,
I would say that probably the lack of regulation, not having any is not really good. Probably another one would be that, as they were saying, the ecosystem is very nascent. And so probably that could, feel daunting and kind of hard, mostly because we're seeing the ecosystem being built and experimenting. And we are experiencing those typical growing pains that we've seen in technology during the 2000s. And so that could be very daunting. The user experience is not there yet, and so it's very much fragmented. And so I do think that, again, it comes to, having, that knowledge, that's why the more knowledgeable you become in the space, the more you understand, where you feel comfortable taking risks. But probably those are the biggest, threats in terms of how we see it.
Great. Jeff?
Yeah, so regulatory is definitely the big one. It's also an asset class where you, by definition, you have variance in your governance structure on how people feel. So if I bring an equity long short manager to our IC or our board, no one's questioning the validity of the asset class. It's just a manager selection decision, and that could be debated. Digital assets, that's not true. And so it's education, it's all those things. But then events like the last 6 weeks, people, it became split, almost like it's political. Like people feel strongly. If you felt strongly against crypto a week ago or 2 weeks ago, you feel worse now. And so that's challenging. I actually think the biggest issue, though, is underneath that. And it's the lack of ability. So if I'm teaching someone about it, there's so few protocols now that are accessible to someone who's not crypto native, the inability to touch and feel. So like if you were investing in early stage tech, they had websites, they had things you could go use, you could see what it was like. I get, even if I said like on a most basic protocol, I want to get someone on Uniswap, I need to set up wallets, I need to take them through, I need to show them how to wire an ETH and all that thing. And so it's just until more of the applications are farther along in development and more accessible to individuals who do not view themselves as supporters of crypto, I think it's going to be challenging to onboard the next order of magnitude of people.
Michael?
So I actually think the hardest part is and maybe it's surely because we're smaller, we're labeled institutional, but we're working with individuals, right? We're not representing, an institution here on the allocation side. and therefore all of our portfolios with clients are unique to them. And the vast majority of our clients are, Michael, do what you think's best for me. I trust you. I like how you think. I like how you communicate. If you think I should do this, you already know my views, sure. Or just know I need X dollars for X, Y, and Z, right? So it goes back to that holistic. It's always holistic for our clients. But actually the hardest part I find for the adoption / growing of how we're going to implement is operational. And it's not internally operational. It's actually the idea of, it's a pain in the you know what to manually enter these things in an aggregate software, to update the client. Like it's so fragmented. And part of it is like, okay, is it really worth me allocating another one or not? And I hate that I think that way, because it shouldn't really cloud my judgment on the investment side, and it does. So I really am hopeful, and I joke to myself often that if I really wasn't passionate and loved what I did, I'd probably go out and start a company that actually made software that someone like me could really use properly and aggregate this stuff correctly without tripping like 5,000 passwords every day. But once we cross, in my opinion, on the RA side, once you cross that spot, and you're starting to see it with certain places on individual coins, so we're getting there. But once we get to the point where these software can, or these custodians will start talking to the software, then it's game on, in my opinion. So it goes back to my view of, we're still early, and I'm willing to take the pain, but I have to be careful of how much pain I can take from a pure like running a business perspective. But once that changes, I think off to the races, because then every Joe Schmo out there is going to say, now I have access, and they're going to pick, not saying all the investments are good, but you're going to see a ton of money rush in because it's easy to implement from the advisor side.
And it made me think of it, it's kind of related, but the lack of uniformity on tokens and when they accrue value and why they accrue value is a big challenge. And so I've had numerous people that were making decisions at other endowments come, and they saw a protocol and they saw how much value I had locked, and like, why don't I invest in this personally or with their firms, and trying to explain, well, this one actually doesn't receive fees and this one does, and this one's just meant to be kept. It's kind of, it makes the learning challenge really difficult, as to where when it comes to equities, you largely know your share of the business, your share of the profits, what dividends, whatever it might be. Some of the, especially the early stage, call it maybe DeFi 1 tokens, like the actual accrual value isn't obvious. And I think people struggle with that lack of uniformity.
I think that's right. And it's just a matter of time in terms of differentiation and I guess the infrastructure that's being built up currently, as well as, just the general awareness around this value accretion, mechanism, and the familiarity around the asset class generally. So we're also kind of hitting on a lot of these points here, but I'm just wondering if you could describe, we know you're a people person, Michael, but if you could describe kind of what you're looking at today in a manager, what stands out to you specifically?
What makes you say I'm a people person? Yeah. I'd love to spend 80% of my time just talking with people if I could, and 20% actually on the business. That's like a dream, right? You have the great team behind you, which is actually the point of your question, which is, I mentioned I invest in people. I truly believe in that, personally, professionally, like in all walks of life. And I also, sometimes I'll get burnt because I trust people too much, and you get taken advantage of. But at the end of the day, I truly believe that the vast majority of people are constructive, positive, value add people. So I look for teams that have that positive energy. That's really, really important to me, really important. And not like the cheerleader kind of, I'm not saying superficial if anyone's a cheerleader, but like, I don't need you on the sidelines, rah, rah, rah. I need you to really believe in what you're doing. I need you to be passionate. I need you to have integrity in what you're doing. And I need you to be transparent. And for example, right, we invest in Arca, and even when times are tough, I appreciate the candor and the transparency, because at the end of the day, I'm a gatekeeper to my clients' money, right? I'm a steward of their money. And I made the decision that this investment was part of what I think is best for them. And for better or worse, I have to defend that. I have to defend the logic. I have to defend the execution. I have to defend the next steps of what we're going to do with that capital, if it's working or not working. And I can't confidently and genuinely offer that advice if I don't believe in the information I have to make that decision. So it's critical to me that people have those attributes. And they also, obviously, at the end of the day, money talks, right? You do well, and there are hiccups along the way. No one's perfect. You use the old analogy of like, Hall of Fame batter. They don't get it right half the time. So like, you have to understand your odds long term. But it comes back to investing in the right people. And you mentioned something interesting that's always a struggle is how do you invest in a team without knowing that the team may be the same team in a decade? And that is tough. That's really hard. And oftentimes the answer is they're not going to be the same team. And you may be stuck in investment, which is good or bad, but you also want to follow the people that you think are the winners who went somewhere else. And before you know it, you have like too many investments. So it's a constant reconciliation, but it's all about the people at the end of the day and the integrity and passion of them.
Great. Clara?
I actually agree 100% with him. It is about people. It is about trust. It is about, engaging with the right team. I feel like probably the most important thing is we actually build, conviction on the space even before we were talking to clients. So we had that sacred space for us to really deep dive into the ecosystem and create that kind of conviction. I am seeing right now a lot of clients that are actually pushing, investments in their portfolio when it comes to digital assets. And I'm seeing a lot of my peers that are not really prepared for that. So I do think that sticking to and being around great people and great talent is the key to go. Our end goal is really to produce returns, and so we have different risk profiles, but we always thought about putting time and effort in educating, not only our clients, but also really our people. And so we would produce research, we would bring different guest speakers. We were lucky enough to bring Jeff to one of the global macro calls that we've done for our own platform and for our clients, and it was an amazing way of engaging with the subject, because it was very clear and thorough. And so I think that it's just about like understanding and getting that level of comfort, and that's people. That's really what people bring into the space. And so having the right fund managers to have conversations and be their first, like have them not in speed dial, but kind of speed dial when something happens, and really, go back and forth with different questions. That was key, at least to us.
Great. Thanks, Clara.
Yeah, I think I agree with everything. The one thing I'd add that I think is unique about this space is stamina is going to be important. It's literally 24/7. I mean, I don't know if Jeff Dorman's around here, but I imagine his sleep profile the last 2 weeks has not been great. And so like, I think historically, when you look at a manager, you want to see, how long you've been doing this, experience. I think you're going to see more turnover. I think you're going to see people alter their roles because it's truly 24/7 and it literally doesn't turn off. It reminds me of when you think about global macro managers, and when you talk to them, they'll tell you they woke up at 2 a.m. and they check this market, and then they go back to bed and they wake up at 5 and they do this. Crypto's like that. We're not there yet because it's only been institutional for a couple of years, but I do think that's going to be an important component.
I agree. All right, great. I guess one final question. I would love it if you guys would just kind of maybe provide a summary of what you think sort of the one takeaway should be here as we're discussing institutional adoption of crypto and digital assets, and just if you have sort of a potted summary of where we are now and your views, I'd appreciate it as we kind of end this panel. Maybe Clara, you could start.
Yes, sure. Probably that the ecosystem is very nascent. We only have 12 years of experimentation with Bitcoin. The rest, we just follow Bitcoin. I would say, deep dive into the asset class, join different conversations. There's so many amazing experts really, helping understand the space better. So I would probably say, read as much as you can. There's great newsletters out there. Map the ecosystem wisely and look for the best talent. I completely agree with them when they say that the amazing talent is, we've seen amazing talent really leaving traditional finance and venture to go into digital assets. So probably from the technology side, it is not very user-friendly today. The user experience is very clunky, but it will get better. So, stick to it. Use some of the projects. I feel like experimenting with them was, the biggest learning experience to me. So I agree. I think I have a very positive outlook when it comes to digital assets. I think that it's only going to get bigger and bigger. I was reading a report from Art Basel. They produce these annual reports, and they were talking that 75% of ultra high net worth individuals already own NFTs in art, profile pictures, sports, real estate, land. And so, the market is going to keep on going. And I think that, what we have to do is really educate ourselves and be open and not be really spooked away from the things that might happen. It's very unfortunate what happened with Terra. But I do think that that the space has amazing talent and it will evolve correctly. And I think that, we should take that challenge and be very mindful about, really, educating our clients and be in it for the right reasons. Like, I don't think that a UST with 20% return is the way to go to manage cash. So just be mindful about it.
Thanks. Michael?
So I compare it, I was much younger then, but I compare it to almost like the early stage of the internet where there's something there. A lot of people are skeptical. You go out and buy 1 or 2 or 3 names that are the leaders, and you actually would have lost a lot of money over the last 15 plus, 20 plus years. But if you had taken a different approach and said, look, there's something huge here. I have no idea what it's going to look like, but it's very obvious to me that there's something huge happening. So instead of me concentrating my bets on a couple of names that are the popular ones at the moment, or that I'm even using personally, I think like my AOL screen name kind of, we all probably have some embarrassments about those things. But it's a great example, right? That at the moment was the hot spot, and you'd say, oh, I'll just put my money there. And you would actually lose all your money, but you were right, but you were wrong on the paper, right? So the idea is there's something really big happening. Do we know what it's going to look like in 10 or 15 years? No. But do we know it's happening? Yes. And you get really high quality teams who go back, who are only devoted to the space and find the best opportunities, because I am a firm believer, not firm as in Magnus, but firm as in confident, that the next Amazon, Google, pick any explosive company out there over the last 20 years, they're in this space already. We just don't know who they are yet. And you got to get lots of deep exposure. And yeah, there's going to be a ton of losers, but a couple of those winners are going to carry everything, and you got to have exposure.
Jeff?
Yeah, so I think the biggest takeaway for me, and I've made a lot of friends across the other endowments and foundations, there's somebody at every single one that's thinking about digital assets. A lot of times now there's teams that are thinking about it. Almost every investment committee pack has some highlight on Bitcoin or ETH or Bitwise 10 or whatever it might be. And then when you think about, so they're looking, some are invested, some are not. And then you think about what institutions are facing. Almost all of them have a hurdle in performance, call it, like for us, it's, inflation plus spending rate. And so to Tom's point earlier, if inflation's higher, than average over the long term, spending rate doesn't change, we have a higher expected return. Then you look at valuations in the market, it becomes challenging. And so if there's an opportunity of an asset class that offers higher than average returns, it's interesting and people will invest up to their risk tolerance. So I think all of that is important. I do think the other piece of that, though, is as institutions come in, the way the market reacts is going to be different, because institutions are going to interact with different protocols, they're going to invest a different way, they're going to sell at different times because of liquidity needs. Like crypto was uncorrelated for a long time because the liquidity needs of those individuals didn't necessarily match up with the market. Now maybe they do. And so you see a correlation, which is probably too high than the market now, but I think it will be higher than average over the long term. So I just think it's indisputable that institutions are looking. It's indisputable that more will be involved in 3 years than are now. I just think if I were investing personally or with my firm, I would just be mindful of it's a different capital base with a different thought process and what that means to what you're holding.
Really helpful. Thank you. I don't know if we have time for a few questions or.
You guys did a great job of talking about how you're thinking about this, forward thinking about this, and also identifying the hurdles that institutions need to get over to get more invested in the space. Could you talk a little bit more about at your specific institutions, how you were able to, in a little more granular level, get people over the goal line to start investing in this space? Because those hurdles are there for everybody, but you clearly have been successful. Curious a little bit more on that.
Yeah, so I think for us, it was quite literally, well, it's two pieces. One, recognizing the advantages of the institution suggests that we're long-term and we know what our redemption schedule is going to look like. And so it means you can take bets for long-term. And we're also able to size this in a way, like we get to pick our allocation. And so anything that's called a lottery ticket, you can size to your risk tolerance. And so that gives you a lot of flexibility to look at new things. When you looked at it from an institutional standpoint, talking about how cool the applications were that were developing on Ethereum or Solana coming, wasn't going to hold weight with people who were against crypto to begin with. Like it might to us, I could probably talk to Rain and we could talk about that and want to invest in things. But for them, it really came down to talent. And it said, what if you don't? So let's just say we skipped crypto. And the venture market is an area where ENF has done quite well and it's a core piece of their portfolio. Well, what if I tell you 25% of the talent that was at those tech startups that were so important to you is sliding over here? And now your investable universe shrinks. Well, what does that mean for go forward returns? And so at some point, maybe it wasn't right away, but over the long term, a zero allocation is kind of a structural short compared to your peers because they're going to do it and you're not constraining your investable universe on something that's core to your mandate. And that was kind of the question, like, do you want to be structurally short this? And not many people want to sign up for that. Most people would prefer at minimum to just match whoever they're comparing their returns are doing. And so when you speak to it like that, and then the other part of it is just excitement. Like when you see the types of talents, like I think in our 2018 board memo, I did the Stanford classes and how quickly the blockchain ones filled up and all of that. It's just hard. If you believe in the way that America has become kind of an economic power, it's based on innovation. And so the innovation comes from what interests people and what they spend the weekends on, and that's not new. And so the more we spent time on that, it was, yeah, we want to be involved in the space. We don't want to take the faults of it. And that led to.
You're a smart dude. You should hang out more. I'll just tell you, like practically speaking, the first foray for us was actually March of 2020 when we wanted to take advantage of a dislocation in the markets, not knowing what was going to happen, of course. Our crystal ball is never that clear. But the idea was like, there's clearly an opportunity here. We're in the fog of war. We should be dipping a toe in something. Right? It goes back to the liquidity. But we couldn't really leverage equities to buy equities. You know, you have to. So where can you go? And boom, wait a sec. We can savvily borrow money really cheap, be very responsible and smart about it, right? Not trying to blow anyone up, but take a bit of I don't say lotto ticket, but take a little extra risk right now. And we can go into digital asset world because it's not a security yet. So we can actually borrow and go, you know, it's totally legit. So a little bit was a dam bursting of like, we got to do something. There's clearly an opportunity here. We don't know where it is, but do something. But it was more reflective of watching it for a while and having enough pressure from clients who were really excited about the space and me recognizing as that fiduciary for them, I don't want you to just go out and necessarily just trade coins and turn this into like something it shouldn't be. Like you actually really need to put some guardrails on and have some discipline and institutional approach. And that's my job. And I'm a believer in it too. So what am I doing sitting here? I should actually be acting on your behalf and helping you. And that's when I personally kind of started breaking stuff at the firm and going, let's say all in, but really saying, look, this really needs to be part of our approach. I'm getting the demand. And it's interesting because I've gotten a lot more clients who love the fact that we're already like friendly about it, right? Like they don't need to educate us on it. They're annoyed that other people are asking them questions in the space. It's like, no, good. You already have this, whether we agree or not. Like, I want to work with you on other stuff because I like that you're already thinking about this. and you're on the same page as me.
Super helpful. I think we're out of time there, but I just want to thank you, Clara, Jeff, Michael. This was great. And thanks for tuning in.
Thank you.